My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be with my friends. I'm just trying to make a little money. My job is not just to entertain you, but to educate and teach. So call me at 1-800-743-CNBC. Tweet me, Jim Cramer. This market feels almost blasphemous to me because we're being led by an outrageously bullish combination of stocks. The kind of stocks that absolutely should not be going higher at the same time. Nobody wants to say it. But I don't know if I can recall a moment where we have such disparate stocks climbing together to new highs. If you would even ask me a few weeks ago, I would have told you this combination that led us today is not conceivable. Yet that's what's happening. Dow gaining another 350 points today, record close. S&P jumped 1.17%, record close. NASDAQ pulled at 1.4%. You guessed it, record close. This action defies the whole nature of the conventional wisdom about what can happen when we're at this point in the business cycle. Now, look, in the old days before the crash of 2000, 2008, we'd be celebrating daily today. Now the commentators and prognosticators, they're circumspect. They just try to ignore what's happening. So they can go back to talking about how the consumers tapped out. Or something we learned about from some incredibly weak retail sales numbers just this morning. Or how inflation is still raging and it's darn frightening. The budget deficit, a consumer price index that's too high. There were even people complaining about how the economy is just too hot still. I know. I saw it twice this morning. I wanted to reach in and grab the TV, right, but I couldn't because, you see, they were right there, and I would have grabbed what I heard. All right, look, just a negative spin after negative spin on all sorts of positive news. Not only no celebration, no positive nature, but really an out-and-out pessimist day. I don't know how they can do it. Then there are the stocks themselves. When you listen to the stocks, they're saying shut up and drive. They're not saying you must not listen to all the strategists and billionaires who are trying their best to scare you to the sidelines. They are telling you those people are awful. The bears have had it wrong. There are just too many groups going higher all at once. That's what's happening. Let's deal with the actual stocks. How can J.P. Morgan, Bank of America, Qualcomm, and Applied Materials make common cause in the 52-week high list? How can Southern Copper and Southern Utility both be on that exalted list? What allows Boston Scientific, the medical device company, and Texas Instruments, the semiconductor company, be in tandem with 52-week highs? It's all about the zeitgeist of this very odd, very bullish time. Let's go over what's really happening with this tremendous rally, because it's defying everything we've been taught about how this business works. I'm going to list them because it's that special. First, for years we've been taught we were either in one kind of market or another, but not both. We could either say have tech go higher or other groups go higher. FANG rallies, but all other stocks go down. Not this time. Not this time. We have a ton of industrials, banks, utilities, and techs all going up at the same time. That almost never happens because utilities go up when we are going into a recession. Industrials typically go down when we're headed for a recession. Techs rally when inflation's low and the industry's got a thesis going, internet, data center, or in this case, artificial intelligence. Financials soar when inflation is getting under control and the consumer's strong enough to pay back loans, but rates stay high. Home builders move up when interest rates are about to plummet. Those things simply can't all be happening at the same time. What kind of vacuum is this? The stocks leading us higher are supposed to be mutually exclusive. What does that say about the people who are buying stocks? It says there are many different camps of investors right now, many groups of buyers, and perhaps by mistake, they are converging. There's a camp that says a weak CPI could put rate cuts back on the table, so they buy the industrials. There's another camp that says you can buy the stocks, buy the banks, because ever since last year's crisis, they've gotten so cheap that you can own them without too much to worry about. There's a camp that thinks that the Fed will leave interest rates higher for longer, causing a recession, so they buy the recession-proof utilities, especially after these weak retail sales numbers we got this morning. The techs can take off because they're in secular growth mode thanks to the artificial intelligence boom, which increasingly feels additive to earnings for more than just NVIDIA. I saw it with my own eyes today when I talked to Bill Reddy, the CEO of Pinterest, who's been using NVIDIA GPU chips instead of CPU chips to hasten inferential picks. The homebuilders can romp because mortgage rates actually went down today. A big deal is it seemed like that the 10-year was headed ineluctably to 5, and that would have driven rates up to 8%. But then we got that cooler CPI report this morning. Second, this kind of rally is built on skepticism. Many investors believe that the key to this market is the consumer. Without the consumer, they say, you can't get to all-time highs.
They know nothing!
That sentiment has left so many behind, trampled by the bullish stampede. They just weren't able to think about anything beyond the same old tattered playbook that no longer fits the market. Who needs the consumer when you've got the enterprise? In truth, you just didn't need the breadwinners out there buying at the stores. Plus, we have to leave open the chance that the consumer stocks could be the next to rally if we get more signs that the Fed might want to cut rates. That will make a lot of quarters for the companies that are in retail that aren't that good look better. And you know what? We are having some layoffs. Didn't we just see a gigantic wave of unexpected layoffs at shuttered Red Lobsters? Unemployment could be ticking up. More important, if you've been waiting for the consumer to break out, you would have missed such incredible moves. Honestly, if the consumer was in good shape, the Fed would be getting ready to raise rates again, which would obliterate nearly everything on the new high list except for the utilities. Yet this weirdly broad-based rally would be truly impossible if the consumer stocks were leading and the consumers were really spending like mad. Third, you know what? The billionaires, they couldn't kill us. A week ago, Barry Sternlicht, card-carrying billionaire and very nice person, came on our air and said that he expects a regional bank or two to fail every week. That's an incredibly dire forecast.
The House of Pain.
Could you see JP Morgan, Bank of America, Wells Fargo, Morgan Stanley, Goldman Sachs, and Citigroup stock all hitting a 52-week high if Sternlicht's right? But if you believe the doom and gloom, his doom and gloom, you got left in the dust, and you should get out now, frankly. I keep waiting for a bullish billionaire to come on here and say, you know what, he really likes the tape, but he's investing in Microsoft, not at the high, but what a run, Qualcomm. Typically out of some applied materials, think Schwab's great, maybe Southern Copper, and Lilly and Merck, two pharma companies that also aren't on the new high list, but were galloping today. Can you imagine if someone came on, imagine if a billionaire said that, you know, Joe, you know, Becky, I really like it here. Andrew, you know what, I'm buying a lot of stocks. Can you imagine that? You'd sit there and you'd say, wow, I'm really learning something. Finally, we must recognize that many investors have been brainwashed into believing there simply wasn't enough money going around to have all these groups go up at once. Here, I think they're missing a lack of new shares created thanks to a weak IPO market, coupled with a bullish investor who tends to put money in index funds. Think of it like this. If you own a stock with a huge buyback like Apple, and we keep getting waves of money coming over the transom in S&P funds, you end up with a stock that has a substantial shareholder base that never moves, including a gigantic slug of ownership by passive index funds that don't trade. A humongous buyback sops up additional stock and then crunches it. Anytime there's a huge wave of actual money coming into the S&P, it picks up stock and puts it away. That means if actual buyers, not index buyers, but buyers come in, they have a giant amount of competition for shares. When you have multiple bidders, like giant company buybacks and huge S&P index buyers, then when a natural buyer comes in, a portfolio manager, say, who wants to buy 2 million shares of a company, well, that buy can move up a stock, even a stock like Apple. So let me give you the bottom line of this amazing time. It's a strange confluence, a remarkable, unseen, unrecognizable bull market, one that happens when the buyers see every glass is half full, even if they're wrong. Even if they're wrong, because their buying can make themselves right just by being aggressive enough. And that's really what happened today. Let's go to Ryan in Florida. Ryan.
Booyah, Jim.
Booyah, Ryan. What's going on?
My dad and I are fans of your show. Look, you can't break my heart today. At these current levels, I love it. I've been buying a lot of it. I know the CEO didn't look too good on the last interview with you, but the drive-thrus are always packed, and they're starting to roll out more and more deals to bring in more customers during the slower parts of the day. What do you think about Starbucks over the next 12 to 24 months?
Okay, I think Starbucks, the stock is too cheap. I think that they have to, let's just say they've got to be realistic that a turn's going to take a while, and that a plan includes having, say, a Starbucks 2, like Panera 2, where they really figure out how to handle throughput, and they figure out whether the baristas can make all the drinks and how to handle the lines and mobile order pay without cutting in front. And they have to do those things. And when they do that, they'll get it right. So, no, my trust owns it. But you see, my trust is down a huge amount. And when that happens, it's my fault. Okay? It's my fault. Because I believed. And when you believe and a stock goes down, it's on you, not on them. The bull market we saw today is one that happens when buyers see every glass is half full. And even if they're wrong, the buying can make themselves right, as long as they're aggressive enough. Well, Mad Money Today, I'm diving into the latest from today's CPI. See what these numbers mean for the stock market. Then, could conglomerate breakups be your money's biggest breakup? I'm looking into United Technologies and GE, and I got another one in there that I think is Bafo. And it's been a half a decade since Pinterest IPO. So I'm going to sit down with the CEO to see what's ahead for the social media standout. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.